Hello, everyone. Welcome to the stock-specific class here for Thursday, January the 28th. Been a really crazy really crazy week, to say the least. But I'm always fascinated when something kind of big and something kind of new hits the market. It really shakes things up, and it just causes these discussions, and it causes market behavior that isn't normal. Now, it can be challenging because there have been a couple times this week where I've just looked at the way things were going, and normally I can on most days I can kind of see what's happening, and it makes sense. It doesn't always mean that the market does what I want it to do or expect it to do, but even when it doesn't do what I expect to do, it makes sense. I can usually see why it changed direction or something like that. But there's been a lot of stuff this week that it has had me scratch my head thinking, I don't understand what's going on. And it's caused me, I kind of liked it in a way because it caused me to go in and start learning, trying to figure it out. And that's always, whenever you gain that experience and knowledge and things like that, it can be helpful down the road. And it really leads into what we're going to talk about today in the training after we do the specific stocks here in just a second. I'm going to introduce you to the Elliott wave principle. Some of you might be familiar with it. It's a type of trading analysis. And I'll talk about, I'm just going to get into just kind of the background and introduction of it today, because we're going to be spending several trainings over the next week or two talking about this and learning about this as part of the training. And so, but it really fits in to what's going on, and it's kind of fascinating. So anyway, I'll get into that here in just a second. But obviously, the big news of the week is the Robinhood traders jumping into GameStop and AMC and BlackBerry, and we talked a little bit about this on Tuesday. I talked the training on Tuesday was about shorting stocks. If you haven't gone through that recording, you might want to do that at some point in time, because I'm not going to touch on everything I went over in that training and that discussion there. But it does kind of help you understand, though, what happened yesterday. Because what happened yesterday is we had this big sell-off, and the VIX spiked up. We'll see it here in a second when we look at the chart. And I've always taught you that the VIX is telling you that it's my definition of the VIX is that it's the indicator that tells you the level of freaking out of the institutional investors, the big money traders. And usually when that starts to spike, it means that the market is likely to go lower. But here we had a pretty big down day. I mean, percentage-wise, it wasn't we've seen bigger in the last year, definitely. But it was a pretty big down day, and that VIX spiked pretty large. I haven't seen it spike like that for quite a while. And yet, at the end of the day, normally my normal analysis would say, man, we're going lower. This thing could get really ugly by the end of the week. But the gut feeling in me said, there's something weird's going on. And I was talking to a friend of mine, another fellow trader, a friend of mine, that, and I said, he asked, because he was asking me what I thought and what I was expecting for it to happen today. And I said, boy, we could, what I'm seeing here on the charts is, and what the VIX is doing, I'd say we're going to have a massively big down day tomorrow. But I have this gut feeling that something's a little different here. And I thought we're either going to be down big or we're going to be up big tomorrow. And obviously we're up big. And I think kind of what was going on is that, and I talked a little bit about this on Tuesday, that we've got these, everyone's kind of piling into they're finding all these companies that are heavily shorted, and they're jumping in and they're trying to squeeze those shorts, and that's causing these stocks to make these big, dramatic moves. Now, obviously, the attention's been around one hedge fund that was heavily shorting GameStop, and they basically ended up closing out their short position. They almost went out of business doing so because it hurt them pretty badly. But the idea that was the only hedge fund with exposure out there is ridiculous. It's not accurate. There's lots of different big money hedge funds. There's lots of big money out there that have short positions. Okay. Hold on just a second here. There's a question here. I'm not on the. We'll look at the VIX here in just a second. I'm just the main front screen here. I'm just kind of introducing before we go and look at our indicators here. I'm just kind of doing a little bit of an intro here of kind of what's going on. But there's all these other big hedge funds that have these short positions out there, and obviously maybe you're not targeted yet, but you know that you could be targeted, right? You've seen what happened. You're scared that they're going to come after you next, and so what do? Well, you've got to make sure you're well capitalized to be able to deal with it. And so you start selling off your winners, and that's why we saw a lot of the FANG stocks, a lot of really good companies that sold off big yesterday. A lot of it was, I'm not saying that all of it was due to this, but a lot of it was due to these big money players kind of raising capital in order to deal with, potentially some of these other short positions that are out there. So it's not surprising that happened, and it's not surprising that money kind of came back in, because one of the things I was talking about with this friend of mine was I think that if the reason why I thought the market could snap right back from the move yesterday is I said if those short positions, those ones that have been going up every day in big ways, if they get kind of broken, meaning if some, and we find out today that they ended up kind of changing the rules on these people and barred them from being able to buy GameStop, which is a whole other topic that I can talk about. That it's not always fair on Wall Street. They can and will change the rules sometimes on you, which is why you don't want to get caught up in these frenzies if you can avoid it, because and I'll use an analogy to that here in just a little bit here, but I figured that if they got broken, then the big money would feel comfortable getting back into the stocks they already loved, and we're seeing a lot of that today as money is kind of piling back in. Now, I don't think this whole thing is over. I think we're going to see a lot of back and forth and a lot of traders like myself trying to figure out, kind of what's going on. But it could throw some of the normal things that you analyze from the normal chart analysis, candlestick analysis I've taught you over the last few weeks. It could throw a little bit of that out of whack because the market is very emotional right now, and it's very emotional on both sides. There's strong emotions of greed, which is really what has been driving those heavily shorted stocks, and there's now shifting a lot of fear. And fear could be on both sides of those trades. So both emotions are heightened now, and so when that happens, expect a lot of volatility. We're likely to see a lot of big moves up and down over the next little period here. But if we look at now let's go through our alerts real quick. We have backed off with that sell-off yesterday. Now these will change a little bit when they update overnight, reflecting today's action, kind of snapping back. But momentum's moved down into the hold area. Breadth is kind of in that trending area there, right in the middle, and sentiment swung all the way over into the fear area with that huge spike in the VIX. Really moved into that extreme. Now that'll back off a little bit because the VIX has kind of come back down today. It'll probably move into this trending area after it updates overnight. But you also saw a lot of the shift in the buy sell ratios, the buys and sells, they've come a lot closer together. Now this is good because if the market is getting prepared for another move higher, and I told you on Tuesday that I felt like the market still was acting like it wanted to go higher. I still feel that way. I also mentioned Tuesday that there's always that potential you could get in a little bit of a sell-off before that happens. Sometimes a little bit of a sell-off sparks the buying. You know, people they want to buy, but they want a little bit of a discount. They want the things to pull back a little bit. And so you get a sell-off like yesterday, and it's like, you know, especially as long as the sell-off doesn't scare people, you know, and cause too much fear, it gives them that discount to go in and buy. They feel more comfortable going in and buying. And that's why I think we're seeing a lot of the snapback take place. And this is good, though, because it's alleviated a little bit of that overbought condition of the market. And we've seen these ratios now come a little bit closer together. They can start to expand back out again. Sentiment shot way down with the selling yesterday. But there again, we were getting close to that extreme. We have a little bit of room now where we can run in the market. And we might see that get back up to that extreme level. And then if we do get a big run in the market and get back up into this extreme area again, that's when I really start to worry about a bigger correction of some sort taking place. And we are going to get a bigger correction at some point. And but I still feel like kind of the craziness of the market right now can last a little bit longer, and I'll explain that a little bit later in the update as well. All right, so let's take a look at a couple charts here real quick. I do want to focus a little bit more on the specific stocks on these Thursdays, but obviously a lot has happened this week. Start with the S&P 500 chart. So again, and you know, it was another thing that was worrisome too off of this chart is, so we get the big move down yesterday, but I mean, we were breaking, if you take a trend line right through here, we were breaking below that trend line. You know, there's a little bit of support right in this area right here that we closed below that area of support, horizontal support. The VIX was spiking and everything's screaming, man, we're going lower here. But it just, again, it was just kind of that gut feeling that that it just didn't seem like, you know, I didn't quite trust what I was seeing there as far as things falling apart. And you know, again, maybe they still do. You know, one of the things I'm going to keep an eye on today is I want to watch is the volume. You'd like to see, obviously we're not going to equal the volume of yesterday, but you'd like to see some higher than average volume. I'd like to be up around this area here on the volume bar today. We're still lagging that a little bit here. So we are dealing with a little bit lighter volume today. Now, sometimes this is delayed a little bit. So, you know, probably tonight is when we'll be able to see if volume did exceed the average. But it looks like things could kind of snap back. Now, I want to go over to the Dow chart here, because what I was showing you on Tuesday, and one of the reasons why I thought we'd move higher is, again, the Dow had yet to break out. It was still kind of moving sideways. Usually when you get these reversals, they tend to happen sharply, meaning you tend to get a run up like we did right here, and then you sell off. They tend to be a little bit more pointed. You don't usually run up and then move sideways and then come crashing down. It's very rare that happens. And so the fact that we've been moving sideways so long right here, I just felt like I wouldn't expect a bigger market reversal until this thing breaks out. But again, you know, you had this drop yesterday. It broke through kind of this support area right through here. But there again, I think that what happened is it kind of sparked that buying, and we're seeing that kind of rebound again today with the move back up there. In fact, let me check the volume on that one on the DIA. Yeah, volume, it might get up. It's definitely above average right now. So, and that's kind of what you want. You don't want to see it be real light volume. on a rebound day. Usually that's a sign that that's a sucker's rally. We probably do have further to drop. But so far the volume seems pretty decent, at least on the Dow chart there. And I don't need to go through all the other indexes, but let's take a look at the VIX though real quick. I mean, that's just a huge spike, a huge surge there. And again, normally you see that, and it's like you're breaking support levels. It's like, man, here we go. But we've come back down a little bit right here now. If you look at this, is the VXY. Now the VXY is a trading instrument where you can actually trade the VIX, which I don't recommend doing. It's a weird. I mean, it's great as an indicator to help you kind of read what the institutional investors are thinking as far as are they worried or are they complacent. But as a trading instrument, it just trades weird. It's if you're familiar with option trading, it would be like trading if there was a way to trade an option on an option, buying a call option on the performance of another call option, which is based off of the movement of the stock. It's a derivative of a derivative is another way to say it. And if you don't understand that, don't worry about it. You probably don't want to be messing with it then anyway if you don't understand what I'm talking about there. But it's not a great trading instrument. So, but the VXY is the way that you would trade the VIX. The actual VIX is kind of like an index. It's like you can't. Well, you can trade an index through an ETF. I could trade the NASDAQ Composite Index, by trading the NASDAQ 100, the QQQ, but you can't trade the actual index itself. It's just all it's showing is a reflection of the movement of all these different stocks. So, but the VIX indicator itself and the VXY, the VIXY and the VIX itself sometimes look a little bit different. Because of that fact, and the actual VIX is down a lot further than this. It's kind of down in this area, right in here, in comparison with that big move up there. So the VIX has come all the way back, not all the way back down, but down quite a bit today, and so that's a good sign that the traders, the professional traders, aren't totally freaking out over all this, and we're not going to have well, at least it's not looking that way. They're going to have big, massive sell-off here. All right, let's look at. Let's go into our individual stocks here. Let's look at a couple. A couple of these we talked about on Tuesday, but I want to bring them up again under the retail sector here. This top one, 98 strength rank, FVRR. Again, what I liked about this. Was that it looked like it was pulling back in kind of that ABC pattern I talked about in the previous training there. I did say you do want to worry about it dropping below here because you don't want to go to a lower low. And on Tuesday I said, it was a down day on Tuesday. I said it could go a little bit lower. You just don't want it to dip below that low. And it did go a little bit lower there, but then we have a nice little bullish reversal on it here. Now, I also said that you'd want to wait for this to go back to that buy signal to get that confirmation. And so that's kind of what we're waiting for on this one right here. Another one in this group, it's the next one on the list there, PDD. It's a 95 strength rank. But like I talk about a lot of times, I like to see that kind of the nice trending move. You get that stair step. You had a nice move there. It consolidated, broke out again, and now it looks like it's consolidating through here. Again, you'd want to see this go back to that buy signal, but it looks like it's getting pretty close to. All right, so and then let's go to the next sector down, which is computer and technology. There's a few in here that I like. 98 strength rank, the CPSH. Now, you remember that ABC pattern class? I talked about how when stocks tend to pull back, they pull back in different ways. Sometimes they consolidate, they move more sideways. The bottom line is they're creating that stair step. But sometimes when they do pull back, you'll get that initial sell off, initial pullback, and then it'll try to rally or it'll try to hold that a little bit. Sometimes it'll rally a little bit. It looks like it's coming back. It looks like the pullback has happened. It creates there's a lot of usually it's the dumb money. A lot of times, as you would say, people that were just waiting, itching to get in. They're just waiting for any old pullback. You get the first little pullback and they jump in, but they're early. And then you get the next move down. That kind of flushes those people out. And then usually that's when the smart money comes in after the pullback and things go higher. And that creates that ABC pattern. That first move down is wave A, the attempted bounce is wave B, and then you get the final flush out move for wave C, and then the trend continues. Well, you had this nice run up, this parabolic run up there, though. That's pretty sharp run up there. You get that first move down. Now here we didn't go up very much, but it kind of stayed sideways for a few days. So that kind of created your wave B, and then you have this, what could be the flush out move for wave C. And then it looks like you're getting a nice bullish reversal candle today. If you switch that into candlesticks. Now, ultimately, though, you'd want to wait for this to go back to a buy signal. It's probably pretty close. Yeah, it's not too far. So, you get a bullish reversal day today, and if it goes up tomorrow again, it probably go back to a buy signal. It could be a nice little entry. Now, you say, well, boy, this thing kind of went straight up. Why would I, do I really want to jump into that? Well, this thing was trading down here forever. And so it something woke it up and caused it to be a stock people wanted to buy, and it shot up. And then now it's come back in its first correction. I don't expect it to come all the way back down here. It shouldn't come all the way back. I would worry me if it came all the way back down there. It should retrace. Stocks tend to retrace about 50% of their moves. That we learned that in the retracement class that I taught a few weeks ago. There's a run up, and it's retraced about 50% of that move. Bullish reversal candle, possible bullish ABC pattern, and then maybe you just kind of wait for that extra confirmation to get that buy signal. Yeah, this thing could be trending. It should be taking off. All these stocks that you look at, Tesla and trying to think of others that kind of consolidated like this before they took off, but they all started down there as a $2 or $3 or $4 stock, and then they kind of got woken up and they started a trend. So, this thing could, it's possible this thing goes from a high of $11 to 20 or 30 or 40, over time, but it could be starting a trend in that direction where it starts trending upward. All right, let's look at another one in this group. We looked at this one on Tuesday, Franklin Wireless FKWL. We won't spend too much time on that, except it's still, we're still waiting for it to go back to that buy signal, but I like that pullback. This ATOM is a 97 strength rank, Adam, out of Mara, I guess is the name of the company, ATOM. Again, notice it's a really strong uptrend right here, but notice how it behaved in the pullback. You had that initial sell-off, it tried to rally, and then it's come back down. Now, this hasn't retraced much, so it's possible this has a little bit further to drop. But, with it at a hold signal right now, you're waiting for it to go back to buy anyway. If it does continue to fall and retrace a little bit further there, you're not going to be hurt if it were to do that, because you shouldn't be in the stock if that was your confirmation to get in. And I also talked about this on Tuesday with Zoom Video, which is down the list a little bit. It's a 96 strength rank, but this had a much bigger pullback, and I just like the way it's looking right here at the bottom, where you had a sharper drop right here, a sharper rise, and it's been drifting a little bit more sideways. That more choppy move right here. As long as this can kind of hold, and like I said, go back to a buy, this thing could be off and running again. So I like that pattern there. Under construction, the construction sector, there's one I like. I remember under construction, and I talked about this before, many times before, but I know there's new people sometimes each week. Obviously, we're looking at the ideals. We're looking at that 98 strength rank, and we're looking to buy, have it go from hold to buy with a 98 strength rank, and then on top of that, we're looking for a nice bullish pattern to go along with it. But some of these sectors just don't usually, especially under the hold section, they may not have that high strength rank. They might, in this case, we're really up in the 80s. There's a 98 strength rank, but I don't know. This is showing that this company is worth 1 penny. I don't know if that's true or not, or if that's it just hasn't. It's not the accurate price here. But if it isn't 1 penny, I don't want to mess around with it. It's not one that I really want to buy right now, because it may not be established very well, or maybe about to go out of business. Who knows? But so the next one down is an 88 strength rank. But I did kind of like the pattern on this BXC. Again, nice uptrend, stair stepping up. A nice little run here, and that's kind of pulling back and a little bit right here, retracing about 50% of that last move up right there. Just wait for this to go back to a buy, and that trend could continue. And then lastly, under consumer staples, we haven't been in this sector for a little while, but some of these stocks have started to look pretty decent. But the top one there, CELH, is a 98 strength rank. And again, you're seeing a lot of similar patterns here that we're talking about. Nice little run up. That could be that first move down for wave A. A little move sideways move right here for maybe wave B. Another move down for possibly wave C. Now it's still down. It's down again today. So, I mean, this thing could keep dropping. But again, if it holds somewhere in here, maybe goes down a little bit further, but if it holds somewhere in this area here and then goes back to a buy, I think that thing could still be trending and moving. So that's why I kind of like that pattern there. And then lastly, under consumer staples, this CHWY, CHWY. It's a 93 strength rank, but I like the pattern. You have this nice little move up here, it pulled back, it broke out. And then again, I like the pullback as it's more choppy, kind of that ABC type look. It's retraced about 50% of that last little move right there. They can get back above here, which I believe if it gets back above here, it'll probably go back to a buy signal. Maybe sooner than that, but you could wait for that little bit extra confirmation. This is pretty close to going back to a buy signal. Yeah, we're getting pretty close there. And I think, if I'm not mistaken, let me double check this here real quick. Yeah, this is a stock that has a pretty high short interest too. So this could be one of those that maybe benefits from kind of what's going on with people looking for stocks with that high short interest. Like I said, the pattern looks fine. All right. All right, so that does it with the individual stocks. Let's get into the training portion today. I wanted to kind of introduce you to the Elliott Wave principle. You might have heard of it and have maybe be a little bit familiar with it. Maybe some of you, if you're not too familiar with it, maybe you'll do a little bit more research about it. Elliott wave analysis, it's something that really changed me as a trader to help me understand the market psychology. I'll be the first one to point out, though, before I start explaining this, that there are Elliott wave fanatics out there. They believe that Elliott wave explains everything that's going on, and that it makes you feel like you can know exactly what the market's going to do. And one of the things you always hear me say, and I'll keep saying, is you can never know exactly what the market's going to do. I don't care what you're using, what indicator, what guru you're following, or nothing can tell you exactly what's going to happen. But there are some of these people that get a little bit too fanatical about this stuff. And one of the criticisms of Elliott wave analysis that I've heard out there is that it can kind of get the feel, and usually it's from the fanatical people, that it's kind of like astrology or something. It's like, well, if Jupiter lines up with Saturn, then Apple stock's going to go to $1,000 or something like that, but and I can see where people can get that idea from, but it's usually, like I said, because of the fanatical application. But if you just take the general principles of what it teaches you, and you don't base your entire trade on Elliott wave analysis, but it's another piece of the puzzle, another bit that you use to give yourself an edge, it works very well, and it definitely is something that it's pretty amazing. There are times where it can make you feel like you are psychic, or you know what's going to happen next. And I think that's why people get fanatical with it, because when it does work, they feel smarter than everyone else. They feel like they found the magic, the crystal ball or what have you. And then at some point in time, the market's going to humble you and remind you that you don't know exactly what's going to happen next. But the biggest thing is that it teaches you market psychology, and it helps you understand how human nature has its impact on the market, because it's based on human nature. And one thing that I've learned about, particularly about crowd behavior and human nature, is it's very difficult to know what an individual is going to do and what their behavior is going to be. But it's very easy to recognize what groups are going to do in that group behavior. And there's a lot of examples I can go into of this, but I'll give you a quick one that just happened recently. Okay, and you can find yourselves falling into this trap sometimes as well. Especially if you're at home in your office and you're watching CNBC and they're talking about something on CNBC. And you go to your computer and you think you're the the only person that's doing that thinks of a trade that they're going to go place this trade, when in reality there's thousands of other people that are doing the same thing. And a good example of this was when this whole Reddit thing happened. They were talking about it on CNBC, and first of all, I was trying to figure out what this group was. So I went and got on Reddit, and it was the Wall Street Bets group. So I got on that, and I don't use Reddit, but I wanted to kind of see what was going on. I started looking at some of the posts, but they were all focused on GameStop. Obviously, that's been the whole talk of the week here. But as they were talking about all this stuff, and that they were squeezing the short positions, they're going as a group and squeezing the shorts, and they're making a ton of money doing it. Some of these people, they're getting in at, well, if we pull up the chart, we can pull up the chart of, and I talked more about this on Tuesday about that whole dynamic with GameStop. GME is a ticker symbol. This thing went from, a $5 stock, and within 2 weeks it got up to, $400, almost $400. That was the peak kind of, actually it went up to 500. That was the intraday high. Today was almost $500. So people made a lot of money on this. Okay, so I'm sitting there, and again, I'm watching CNBC as well, trying to learn more about this whole dynamic, what's going on. And my thought was, well, if they're doing it to this stock, and they're making a ton of money about it, and everyone started to talk about it, I have a feeling they're going to go look at other other stocks with high short interest, and go start trading those. So I went and searched and found out what other stocks have high short interest. I found about 150 of them or so. I narrowed the list down to more of the stocks that I kind of recognized, the ticker symbols I recognized, and I went out and traded some of those. Well, some of those went flying over the last couple of days. Well, again, for me, I was thinking that I was this genius that was coming up with this great plan to go make money on this unique event that was taking place. But in reality, what was happening? I wasn't the only one watching CNBC. I wasn't the only one that has experience in trading. There were thousands and thousands of other people that were thinking and doing the exact same thing that I was. And that's the interesting dynamic of Elliott Wave, is that a lot of times we think that we're doing things uniquely, that there's a unique reason why we're buying this stock or selling this stock, when in reality, we're acting very predictably. We're doing exactly what the rest of this whole big group is doing, and we're behaving in a very predictable way. I'm sure that someone that was just I'm sure there's someone out there that was like, guess what's going to happen now? Everyone's going to go and buy these stocks because they think they're doing it individually when actually it's very predictable. So it didn't surprise me at all. Those stocks jumped up and performed, and thank goodness to my advantage there. Now, when we talk about crowd behavior and being, trying to go against crowd behavior, I think one thing that you have to keep in mind is that, and we talk about human nature too, is that it's sometimes it's hard to detach yourself from the crowd. Meaning, it's real easy to think that I don't do that, or I'm not going to be part of the crowd. I'm not part of the crowd. It's those guys over there. Those are the idiots that don't know what they're doing. It's really easy to detach yourself from the crowd, and it's easy to do that with Elliott Wave analysis, where you can recognize some of this crowd behavior, but you think that it's not affecting you. I can tell you right now that unless you're not human, which is why we call it human nature, there are times where you're going to be part of the crowd, and you're going to do stupid things in trading, and you're going to get greedy and fearful and do things, make those decisions as well. And so an Elliott Wave analysis is not going to completely take you away from being part of the crowd. What it does is it helps you understand a little bit more about the crowd behavior, particularly as it relates to trading, and so you can better recognize a lot of times when you might be being part of the crowd, and recognize at times when you can go against the crowd and possibly do very well by going against the crowd. In other words, it's one thing to understand what you're supposed to do, and it's another thing to actually do it. I learned this lesson when I was a teenager. Just a quick story here, but it helps illustrate the point. My parents had a dinner group that they would meet every month at the different friends' houses, and they'd all get together and have dinner, and they'd go to different houses each month. And there was about 12 of them in the group or so, and about 12 couples. So it's a pretty good sized group. But out of this 12 couples, there were 2 couples that were marriage therapists. Okay, and and I got to know these families pretty well, because they were always coming over from time to time. And when I got in my older teenage years, I was kind of confused, because the only 2 people out of that group, or 2 couples out of that group that got divorces, were the marriage therapists. And in my teenage mind is thinking, these people are supposed to be experts on marriage. And they're the only ones in the group that got divorced. Now, I understand there's a lot more dynamics to go into relationships. And obviously, I know that better now as being older and having my own family and everything. But it made me recognize that you can be an expert at something. You can know what you're supposed to do, but not necessarily do it. And so we're going to have this battle as we learn Elliott Wave and as we try to apply Elliott Wave. We're going to have these times where we are going to be able to trade against the crowd and do very well and feel like geniuses. But I want you to understand that there are also times that we're going to be part of the crowd and we're going to be part of those idiots that we sometimes like to call out when we're thinking we're smarter than everybody else. So, but it's fascinating. Now, what I also like about Elliott Wave, and again, all I'm doing today is just kind of going over the background of it and building a basis or kind of going through the basics of it, of what it is. We'll get into the actual details, like I said, over other classes. Just not enough time in these trainings to do it all at once. But one of the strengths is that it helps you recognize, because you learn about these cycles and you learn about this behavior, you're able to very often recognize where you are within a trend. You know, are you in the early stages of a trend? Are you in the later stages of a trend? You know, if I'm drawing a stair step right here, the analysis very often can let you know, hey, you're in this is acting like you're in the early part of the trend. You're going to want to hold this thing probably long term and trade it for a number of weeks or a number of months, or maybe you can recognize that you're probably in the middle of a trend and you still have a lot of time to trade this, but the trend's a little bit more established, and you'll be able to recognize when you're probably in the later stages of a trend. You know, one of the things I talked about a little bit earlier in the update is I've talked about this before. This what's happening right now in the market feels a lot like the internet bubble of 2000, and obviously that we call it a bubble for a reason is that you know, it ended up bursting and we ended up having a big market pullback as a result. But we also reached these extreme conditions, and then they lasted for a little bit longer. I remember thinking the market was going to had to fall apart when it was December of 1999, because it was already at a crazy level that was probably unsustainable. But it didn't crack until April of 2000, so it lasted beyond the period that I thought it could last. And this is feeling a lot like that. Now, the thing about bubbles is that nobody ever wants to be part of them. Again, to get back to human nature, and you know, we never want to be we never want to be, or we don't want to be on the downside. We don't want to be there when the bubble bursts, or when the music stops and the game of the musical chairs. And so, you know, and a lot of people talk about bubbles, but a lot of people that talk about bubbles don't understand the psychology of bubbles. And again, I'm going to be teaching this over the next few weeks, how to learn how to recognize some of that. But this has a feel of that. And the thing about bubbles as well is that they're always obvious after the fact. Now, what drove the bubble in 2000 was there was a lot of money that came into the system because they were worried about the Y2K thing. Remember, some of you that remember that back in 2000, all these computers were going to shut down in the year 2000, and planes were going to fall out of the sky and things like that. And there was a lot of worry that, because nobody knew what the market damage was going to be. And so the Fed flooded the money with a lot of liquidity, to be able to try to lessen if there was a big result from that it would lessen the outcome of it. Well, obviously the Y2K problem was not that big of a deal, but there was all this money in the system and it had to kind of go somewhere that went into the markets. So what was happening was all these stocks were getting extremely overvalued, and there were companies that all they were basically a business plan. They weren't even an actual company yet. They were just an idea, and they created a company and just created the company. They weren't doing anything yet. They just had this idea, like, I'm going to make battery operated airplanes or something like that, and then they were selling the stock, and people were buying the stock, and they think, oh, that's a great idea. That'd be cool if that could happen. And they were just, all this money was flowing in, but these companies weren't making any money themselves. So it was obviously, in hindsight, you're saying, well, how stupid is that? Well, at the time, everyone was caught up in the frenzy. That's why they call it the dot-com bubble. Anything .com related to the internet, people were buying. And what happened is it ran up, and I remember, because that was in the early days of my trading. There's a lot of people my age that remember this, because that's kind of when they got started as well, around that time. I actually got started a little bit earlier than that, but I just remember that the getting caught up in the hype. It was whatever you bought, it went up and you made money. It was so easy to make money. I thought trading was the easiest thing in the world. And then what happened was it got to that extreme. The bubble burst, and then in hindsight, everyone looked back and say, well, how stupid were we to buy into all this stuff? Well, you could apply. Now, what happens a lot of times with these bubbles is that when another one starts forming, you expect it to be acting like the last one. So, everyone's kind of looking at company valuations this time and saying they're trying to look at the same thing as back in 2000. Well, usually bubbles don't. The next bubble isn't the same as the previous bubble. It's something different. Because the reason why another bubble will form is people will start to say, well, it's different this time. Okay, it's not the way it was back then, so that justifies your reason to keep doing what you're doing. And this falls into this whole idea of these cycles that we're going to talk about with Elliott Wave. That and we're starting to see that now. We're starting to see the same thing, not in the same way, but what we're seeing now that I think is going to be the catalyst for this market correction when it finally happens at some point, is going to be related to what we've seen over the last week. That it's going to be related to people chasing shorted stocks and making big money doing it until it finally doesn't work anymore, and it can kind of crash the market. And we saw a little bit of that yesterday, that the potential there of how when it does kind of break, or if it does get worse, it could bring the market down quite a bit when it finally happens. I'm getting ahead of myself here a little bit, but let's go in and go in. I'm going to bring up a slideshow here. I'm just going to go over, I'll have some other slides in the other classes, but I want to go over just kind of this background of the Elliott Wave principle. First of all, the Elliott Wave theory was developed by a trader in the 1930s named Ralph Nelson Elliott. A couple things to point out here that I think are important is, first of all, in a couple of words here. He developed the Elliott Wave theory, but the title of the slide here is the Elliott Wave principle. Now, what's the difference between a theory and a principle? Well, obviously, a theory is just something that you start off with. It's like a hypothesis, right? And then when you kind of prove your hypothesis, it becomes a little bit more solid. Now, that's kind of what happened here. He developed a theory. Over the years, it's been more proven to where now we call it the Elliott Wave principle. Now, there is another difference here, though. It's not the Elliott Wave law. I don't want to, because laws are absolute. Law is like the law of gravity. If I jump off a 20-story building, I'm going to land at the bottom of that 20-story building. There's not a high chance I'm going to land, or there's not a low chance or a medium chance I'm going to land at the bottom of the building. There's an absolute chance I'm going to land at the bottom of the building. So we're not dealing with laws here. As a principle, it means that it's not perfect. It doesn't mean it perfectly explains what or predicts what the market is going to do. But another thing that's fascinating is the time that he developed this, the 1930s. As you learn more about this, I think you'll appreciate why I'm fascinated about this. But this was back before computers. This was back before really they had charting. They didn't have charting services. In fact, the charts back then that they had, there were very few stocks that had charts because they had to be plotted individually. You had some guy at the brokerage house that would plot the movement of GE every day, and so traders could actually see or it was usually the big institutional investors, the broker houses that would be able to see these charts, but he was able to do all this stuff, learn all this, or be able to present all this stuff without having the technology. Today, I can understand someone having all the tools we have today, being able to come up with something similar to this. But that's what's kind of fascinating to me, and I think you'll feel the same as you learn more about what he discovered. But he discovered that social and crowd behaviors tend to trend in identifiable patterns or cycles, and that these patterns are governed by human social nature and therefore have productive, repetitive forms that have predictive value. This goes back to what I was saying earlier, that it's impossible to really know what an individual is going to do, but it's very easy to predict what a crowd is going to do. In fact, whenever you see these big riots that take place, whenever you see them on TV, they seem very chaotic, right? They're people, throwing stuff and lighting fires and pushing over cars and things like that. It looks very chaotic, but there's actually a predictive pattern, not perfectly predictive, but there's a predictive pattern that all of these riots kind of go through. And that's why the riot police are always, when they actually want to step in and do something, are usually always able to stop those riots, is because they know what the pattern is. And so they're able to kind of recognize that pattern and act. So these individuals in the riot think that they're doing all this stuff randomly, when actually they're doing things that are very predictive. And this happens on charts, though, on stocks. And that's what we're going to be learning about is some of these patterns. And before we get into and we'll start getting into the actual analysis next week. But like I said, it's based heavily on these patterns or cycles, and all of us have been through these before. That's why it's based in human nature. You maybe you struggled a little bit in your life and didn't know where things were going to go, and then you started a business, and that business, it doesn't have to be business. It could be anything in your life that made you happier or made you confident. But let's say you started a business. That business did very, very well, and it became very successful. And then it kind of peaked out, and then eventually, maybe you started to get depressed, and you developed a alcohol problem or something like that, and it destroyed your business, and you came all the way back down, kind of to rock bottom, and you kind of started over again. And then you got your life back together, you started another business, and it kind of repeated that cycle. I think if all of us look back in our lives, there's different types of cycles that we see in our lives. Our lives are not always perfect or great or happy all the time. And again, that's what's kind of going on. There's these cycles. Now, it's not just in our own personal lives. I mean, there's a lot of things that kind of follow these cycles. One of the funny stories I remember from college was, this will date me a little bit, but back when I was in college, they used to have the music video channels, MTV and VH1. And on VH1, they used to have this documentary series called the Behind the Music, and they would show kind of the history of these different bands, and it was just kind of popular at the time. And I remember one time I missed one of the episodes, and my roommate was like, "Dude, you missed this cool episode." I don't remember what band it was, and I remember joking with him, saying, "Well, let me guess what happened. This band, group of high school buddies or whatever, got together. They formed a band. They were doing these low, these going to bars and stuff. These low volume places to do to play their music. And then someone discovered them. They got a hit song. They got really big. So here they were struggling to get started. They had their hit song. They became very popular and were playing in stadiums. And then what happened is they got so successful that they started getting into drugs and alcohol and sleeping with each other's wives and girlfriends or what have you. And so the band members started to fight. And they ended up breaking up the band. And then, eventually over a number of years, they all went through rehab and mended their relationships and then got back together again and had a reunion tour. And the joke of it was that if you look at any rock band or any band for that matter out there, it's the same cycle. It may not be exactly the same, but it's almost always the same cycle. And that's what Elliott is talking about here, is that it seems random, but it's very predictable. And that was the joke I was saying to my roommate was I didn't have to watch it. I knew exactly what. You just tell me the name of the band and I'll tell you how the story went. In businesses, Apple's a good example of this. If you weren't aware of Apple, they started out in the 80s as a PC company making computers, personal computers. They're one of the early companies doing that, and they got very successful, made a lot of money. And then, if you remember the story there, that they ended up firing Steve Jobs. The stock was, the PC market was getting kind of saturated. The company was not doing as well. And I don't know if you're aware of this, but they were within a week or so of either going out of business or being acquired by another company. And obviously they ended up actually neither happened. They didn't get acquired. They ended up hiring Steve Jobs back. Steve Jobs had some new ideas. The ideas were the iPod and the iPhone and the iPad and all that, and the rest is history. It kind of exploded back to this huge company. Well, that's not where the story ends on Apple. They actually went to they actually kind of got saturated with that. Their phone market and everything. They weren't coming out with new products anymore that blew everyone away. I mean, you could throw the Apple Watch in there, but that wasn't nearly as explosive as the iPhone, obviously. And a couple of years ago or so, Apple stock came down. Now, by the way, these cycles, I'm not suggesting that Apple was going to go all the way back down to going out of business. A lot of times with these cycles, they can overlap, meaning that you come down again, but not nearly to the lows that you were before, and then your highs are bigger. You come up to bigger highs right here. And that's kind of what we saw with Apple's. That phone market got kind of saturated, and the stock came way down. And then what did they start to do? Well, they started to get into these services and the Apple Store and all that other stuff, and they're seeing this big growth phase again. They just recorded just an astronomical. It was over $100 billion they made the quarter and that was for the quarter. That was reported just yesterday. So, but what we're trying to learn here is how to recognize where we are within the cycles. I don't want to be buying a stock when I think it's right up here at the peak of the cycle and about to loop back down again. But I can tell you that if you're going to try to get into a stock down here, when it's starting to move back up, it's not going to feel like you want to get in down there, right? You're not at that success level yet. But anyway, I'm getting ahead of myself. We'll learn a little bit more about that as well. So that's a little bit of the introduction of Elliott Wave, kind of teasing with it today. We'll really start getting into more of the details starting next Tuesday. We'll actually learn about the waves, and we'll kind of go from there. All right, thanks everyone. Have a great week. We'll see you Tuesday for the next market update. Have a great weekend. Bye now.